In February 2020, the stock market hit an all-time high. A month later, it suffered the fastest crash in market history. By April, 22 million Americans had lost their jobs in just 2 weeks. The economic collapse mirrored the devastation of the Great Depression. On March 23rd, lockdowns were just beginning across the country. Unemployment hadn't even started to rise in the official data. The true extent of the economic damage was still entirely ahead of us. Yet on that exact day of maximum fear, the market stopped falling. Over the next 2 months, stocks surged upward by 30%. People were losing their life savings, and local businesses were boarding up their windows. Meanwhile, Wall Street was celebrating a historic, record-breaking rally. If that looks completely disconnected from reality, you are not alone. But this is not a glitch or a broken system. The market is functioning exactly as it was built to. So why did the panic stop on a day when the news was objectively getting worse? This chart tracks the VIX, commonly known as the Fear Index. Notice this massive vertical spike in early March. Markets do not crash because the economic data is catastrophic. They crash because investors have no idea how deep the bottom is. That blank void was filled on March 23rd. On that specific day, the Federal Reserve announced unlimited quantitative easing, and Congress raced to pass the largest stimulus package in American history. The intervention gave the pandemic a definable shape. Once investors could calculate the parameters of the crisis, the panic subsided and the buying began. To understand the timing, we have to separate the economy from the stock market. Economic data like unemployment and GDP are backward-looking. They report what happened last quarter. The stock market is a forecasting machine trying to predict the future. This timeline illustrates how stocks are priced. Investors ignore today's closed restaurants, calculating what a company's profits will look like years down the road. If they believe a company will survive, they figure out what those future earnings are worth right now. Traders fully acknowledged the devastating lockdowns on March 23rd, but they looked straight past them, buying up the 2022 recovery at a steep discount. When news reports the market went up, they mean the S&P 500. This pie chart represents that index, heavily dominated by global megacorporations like Apple, Microsoft, and Amazon. Roughly 40% of all S&P 500 revenues are generated entirely outside the United States. A domestic recession can easily crush American workers on Main Street, while these massive global entities keep selling cloud services and iPhones across Asia and Europe, propping up the index. The Federal Reserve also heavily manipulates the scales. In a severe downturn, the Fed slashes interest rates to zero and pumps trillions of dollars directly into the financial system. This scale shows the mechanical result of rate cuts. When the yield on safe investments like bonds drops to zero, it forces that money out of safe havens and directly into riskier stocks. Traders call this the Fed put. It is the deeply held belief on Wall Street that if markets fall far enough, the central bank will always step in with a safety net. The economy was collapsing, but the rescue package was already being priced into the market before the ink was dry. Markets do not always bounce back in a matter of weeks. During the 2008 financial crisis, the S&P 500 fell for 17 straight months. In 2008, investors faced a much darker question: whether major banking institutions would survive at all, and if global credit would completely freeze. The market's forecasting machine fails when it cannot see a clear path for the underlying financial system to survive. Even when markets recover correctly, we have to ask who actually captures that growth. Federal Reserve data shows the wealthiest 10% of Americans own 89% of stocks, while the bottom half owns 1%. During a recession rally, new wealth flows almost entirely to people already insulated from economic pain. A booming index does not mean small businesses will reopen, and it certainly does not mean wages will rise for the average worker. The stock market is a highly sophisticated tool for pricing future corporate earnings. It is not, and has never been, a measurement of human prosperity.